Chris, just give us your take on the implications for the euro, given this bailout really is set to go ahead now.
Yeah, certainly. Well, what we're seeing at the moment is a relief rally, and this morning the euro's opened a bit stronger, and it's also resonated as such across high-yielding currencies such as the Kiwi and Australian dollar. Essentially what we know at the moment is, well, before the bailout, there's a lot of speculative money gone into the euro in the sense that looking for the actual bailout package to go ahead. And now this has happened, we need to have some foresight in terms of what's going to happen. There's a few major risk events coming up for the euro, namely we'll be looking at the finer points of what this bailout indeed entails. We know at the moment it is going to be tens of billions of dollars and less than 100 billion euro, I should say. So tens of billions of euros. But I consider this a prime risk event for the euro going forward, and no doubt we'll continue to see some more conjecture about possible, I suppose, spread to other European states, although this has alleviated this somewhat in the early stages. But one would expect reality to set in throughout the week at some point with some further sort of weakness from the euro.
And Chris, good morning to you. I'm just wondering what the prospects of sterling as well, because the pound, and given the UK bank exposure to those Irish banks, just how are you seeing the pound's position into this week?
Well, it's a tough question. Sterling is at the moment tracking slightly higher, and we expect to have, I suppose, a more muted response to these particular problems coming out of euro than the euro itself. And this is obviously going to depend on what we see from bond markets as well. If we do see a sustained sort of easing of cost associated with debt yields and the like, we do expect this to resonate across the euro, across the sterling once again. And that said, the risk of sterling turning around is also great, but certainly much more muted than I would expect than what we're looking at the euro at the moment.
And how vulnerable in turn is our currency to kind of, though indirectly in a way obviously from that issue, but the other twin competing global concern being China? Bernanke, the Fed chairman, making comments. It's almost like that typical tit-for-tat back on the table. It was Geithner for several weeks, the Treasury Secretary. Now it's the Fed chairman saying, China, stop artificially keeping your currency, I guess, depressed.
Absolutely. Well, the market's well and truly aware of these issues, and I suppose in some ways we become immune to it as time goes on. There's no doubt that any surprises from China this week, the Aussie dollar is certainly on the back foot, so to speak, and you know, that's one driving factor for the Australian dollar. But we do expect the correlation of the Aussie dollar and US equities to remain the primary driving factor. This week in the States, we have a number of key economic information, including gross domestic product, and of course throughout the week we have some other consumer spending information ahead of what they call Black Friday, which is the unofficial start of the shopping season. So essentially, we believe that these events in the States will decide where the balance of risk falls, and we know just how important it is for the Aussie dollar upward momentum to be helped by US sentiment.
And so you're saying that is a bigger driver of overall currency markets than, say, that European issue or the island issue?
Well, not necessarily the overall currency markets. We do obviously see the importance of looking at this when concerning countries such as, or currencies such as the euro, and as Carson mentioned, sterling. But one would think that if we have a look over the last week, we have seen, I suppose in many ways, a more muted response from the rest of the world in relation to this. This is obviously arguable, but if we use, say, the S&P 500 as a key barometer, we have seen this finish the week relatively unscathed, around the 1199 levels. And so it shows me to a certain degree what we are seeing is a more muted response across the board. And there's little doubt if we see a fall on the euro, it has a propensity to also shift across to the local currency, commodity currencies and other risk currencies, but certainly not to the same extent as we did from the Greek financial crisis 6 months ago.
Are you sort of taking some comfort as well, Chris? You look at the VIX closing out the week at its lowest level since April, so risk appetite has not been completely decimated at all throughout all of this.
Yeah, absolutely. It hasn't been completely decimated, and I suppose it's we've had this view for a couple of weeks since this Irish debacle began, or the fears raised once again. And I suppose when it comes to something like this, we generally think of the steps Ireland are taking to bail out, essentially seek help, as more of a symbolic measure, something which will alleviate or will bring down the cost of doing business in Ireland in terms of the debt markets and things like that. So I think the rest of the market also is also of a similar opinion in that sense, where we are seeing a more muted response this time around.
What do you think can continue? What factors can continue to hold up risk sentiment? I get we've had the Irish bailout, but some would say that the impact on that might be fairly muted. You've still got the questions about QE2 and whether it will work and how it works from here, and obviously China tightening up conditions in that economy.
Absolutely. Well, part of our bullish sort of feel for the Aussie dollar comes in with US dollar weakness as well. We know at the moment there's still a hangover as such with quantitative easing measures. There's still a lot of question marks surrounding if indeed they will actually work. And as time goes on, we'll no doubt see this play out in terms of economic data. And this is why investors will essentially be keeping a very close eye on consumer spending, business investment, and of course employment figures going forward, which will no doubt decide where the balance of risk falls. And this is in the long run a bad thing for the US dollar, which is a good thing for the Australian dollar. But in long term, the best fundamentals for the US dollar, as Mr. Bernanke said a little while ago, come in the form of strong fundamentals from the US economy.
Well, there's a whole lot of more issuance that the Fed's embarking on this weekend. As you say, a shortened week. Those yields up in anticipation. The battle for, I guess, for debt is out there now in a big way. Is Portugal going to feature, do you think, this week? Will they be the next ones to have to seek solace through those the non-commercial money markets?
Well, certainly, the pig nations, you could say, will all feature this week. There's no doubt that when we are in a position where a particular country is highlighted for its economic uncertainties, it also spills over and it brings new articles, more conjecture, and certainly Portugal has been one of the prime targets and will continue to be. Whether or not, as I was mentioning before, whether or not this has the same effect as it once did is a different concern. And also, investors also know that the IMF and European Union are all too ready to stand by for assistance if the need arises. So this is what's helping the euro at the moment, and this may also help to alleviate these other problems coming from Portugal.
Chris Gore, we appreciate your thoughts today on that, all of that. Much appreciated, and
Thanks very
we'll
much.
chat soon. Thanks, Chris Gore from GoMarkets in Melbourne.